everyone, and welcome to the second session here at Traders Talk with Alex. Alex, thank you so much that you really took your free time to be 2 hours with us. It was fantastic to know you in the first hour. We even didn't finish yet, really. So I will start with finishing the first hour with a couple of random questions just to know you, and then we go back to your trading strategy. We go deeper in this hour to your trading strategy, how you analyze and how you trade. Okay. So to your trading system. My first question to you is, what kind of holiday do you like? Are you a person that likes to relax on the beach and not do anything? Or are you a city guy and sightseeing cities? Or you're an adventure guy who goes into the mountains?
That's a good question. I would say I'm definitely my wife and I have two types of holidays. One is the relax at the beach and do absolutely nothing. And the second one is we go out sightseeing when we try to jam pack as many things as we can. And by the end of the day, we're literally exhausted. So to give you an example, a few months ago, we were in Spain. We visited Barcelona and Valencia, and we saw so many things. But at the end of the journey, we had to note down everything we said because it was like so much stuff. So it was like completely exhausting. We need a holiday from our holiday. But when we go to the beach, that's completely vegging out. I mean, we'll go to the beach, we'll, take food with us, obviously we'll be away from, we'll be away from people because we want to be on our own, relaxing. So these are the two extremes.
Fantastic. And you're combining, and I assume on the beach you are recharging from all your work you're doing during the
year. Absolutely.
Fantastic. I wanted to ask you about a trading book also that really influenced you, that you can recommend also to the viewers.
Good point. Right. My answer to that would be depending on the topic, or actually the level, because there are, 5 levels to trader development. And depending on where the person asking me is on that scale, on these stages, I would recommend different books to them. So if you're starting out on the first stage, it's a different thing. But if you're on the 5th stage and you want something more specified, I would recommend a different book. But more generally speaking, to come back to your question, I would recommend books from my two good friends, Larry Williams, Tom DeMark, also by friends of mine like John Bollinger and Martin Prink. Because each one has a different style. For example, Martin, I had the pleasure of meeting probably 10 years ago, 12. He combines technicals and fundamentals very well. So if someone asks me, okay, where can I find a book about that? I would direct him to that, or intermarket work by John Murphy. If someone were to do commitment of traders work, obviously, would be Steve Breeze or Larry Williams. If they want to do some more innovative techniques for price exhaustion, obviously, the question would be the answer would be Tom DeMark, who's a brilliant, he's like a genius. So again, it depends. If you want to be more, to understand a bit more about charting in general, that depends on the topic you want to emphasize.
Okay, amazing. What are your hobbies? What do you do outside when you try to relax from the charts? And what do you do?
Spend time with my family. I think that's number one. And also because I have the pleasure of not living in an urban environment. My wife and I moved away from urban. I don't live in London. I'm in the south. And our house is out in the countryside, which gives me the opportunity to be in a wonderful environment. Near the forest, we're like a 5 to 10 minute drive from the sea, the ocean. So spending time outside, that is also weather permitting, of course. That is also something I enjoy. And with friends and family. I also like photography. My father-in-law gave me a camera when my wife and I got engaged. So I did a course to learn how to use it properly. And I learned some kind of like basics, but never emphasized too much on it. So photography as well. So that's my general interest.
That is very interesting for me because that's my hobby too. That I use photography as, as a balance, like it's my artistic part. What kind of camera do you have?
Well, it's a Canon. My father-in-law gave it to me. It's nothing too specialized or anything. I don't remember the type, to tell you this. So I'm not advanced or anything like that. So I just try to learn how to use it. I love photography, but I can't say that I love it enough for me to like give it, learn more about the tools, the techniques. And I mean, I'm a hobbyist. And as a hobbyist, I do things when I want, not because I have to.
Absolutely. You mentioned 5 stages to become a trader. Please elaborate. What are those 5 stages?
Pretty much like anything else, there are levels to this. I mean, there are levels of learning. The first, as a general introduction, it was before I created the smart trader system, which is basically tries to identify where you are at that stage and use the proper tools and techniques for it. I got influenced by the work of someone called Noel Bursch. I mean, you probably know the conscious and the conscious and unconscious competence model. Basically, it was 4 levels. Without getting too elaborate, the bottom one is unconscious incompetence, where basically you don't know that you don't know. The second is conscious incompetence. You still don't know, but now you're aware of your ignorance. The second level is actually conscious competence. I mean, you're good, but you have to be very, deliberate about it. You have to think what you're doing. And the fourth level is unconscious competence, which is basically you've become so good at something that it's become second nature. You don't have to think about it. So taking this model, I tried to adapt it for trading. But instead of doing 4 levels, I did 5. And they form the acronym SMART.
Okay.
So the first level is S for self-awareness. Because that's the first thing that people have to know in order to, get to know what is and use the GROW model. GROW means for goals. What is your goal of trading? You want to trade for income or do you want to trade for growth? Do you want to be trading part-time, full-time? Because there's a different path you will be following to that. Then you have to look at the R for this, the realities. So that's the model within the model. And the realities being basically what is the roadmap to go from point A to point B. The O is the object, so what will be obstructions in your way. And then the W is the will. I mean, how much are you willing to commit to this? So once you've done this self-identification and self-evaluation, you're still at the level 1, the S. If you got that, then you have to go to level 2, which is the M. M for market knowledge. Then you go into seeing the technicals and the fundamentals. And there is a roadmap that I've created, the 10-step roadmap with the tech outlines. I mean, we briefly touched upon it. Touches about how to combine technicals and fundamentals. So that's the market knowledge. A lot of people get lost here as well. I mean, we can be spending a lot of time on this, but let's briefly outline it. The third level is the A for action plan. Because during the second level, you're getting the knowledge. If you put it in a cooking analogy, you're laying what the flour, the butter, and the milk is. You're laying the ingredients. But having the ingredients, that does not mean you have a recipe. So at the third level, which is the action plan, you take the ingredients, the fundamental and the technical ingredients, you put them to a recipe. In our lingo, that's a trading strategy. But, as we all know, again, going back to the cooking analogy, having a recipe does not make you a cook.
Yes.
So you need to practice it. So that brings us to the fourth level, which is the R, which is repeat, record, and review. And that's the difference that makes the difference, because someone can ask, okay, give me a strategy, and I could provide it with them. But by and large will fail, and the reason is because you have to practice it. You have to work on it. It's not a plug and play, and that's the difference that makes the difference. That people who are really committed to the people that are interested, because at the first level your motivation level is zero. You just want to get rich quick. At the second level,
Yes.
You're interested. At the third level, you're just a bit enthusiastic about it. But the fourth level, when you actually get to practice, then that's the commitment level. And then you reach the fifth, which is the trading level. Actually, then you at the T, you become at the fifth stage. And of course, you have to do work on that. You have to work on your techniques, because markets change, that some tools become obsolete, so you have to replace them with new ones or find new ones. So complacency shouldn't be part of our vocabulary. So these are the basically 5. And at each stage, you have to be using different systems, if you will, because each stage has its own system.
So I think this is amazing how you put it. You very simplified the past, and I totally agree what you're saying. Well, what would you say for each stage? How long does it take? Because in the internet, people try to tell you can be a trader in a week, and you just double your account every month. Is this
a week? That's too long. No, I mean, again, the question of timing to achieve these goals, I cannot say how much it will take. What I can take is what is the minimum it requires. Because how it actually goes, it depends on various personal circumstances. For example, if someone asks me, okay, teach me how to do this, we might have Gil who comes is able to devote full time to it. Or, for example, as we know, we spoke with previously with Anna Maria. Anna Maria may come and say, look, I'm a part-time. So people will come with different time. The second thing is that they may come with different educational background. So that is both good and bad, because I usually prefer people who come with an open mind, because sometimes learning to learn is easier than learning to unlearn. So to come back to your question and provide a time frame, I think it's very realistic to go from level 1 to level 3. I mean, know the basics. I have strategies within, I don't know, probably 2 to 3 months. But the longer part is the fourth stage. So going back to the Pareto principle of 80-20, it should be 20% theory and 80% application. So if someone asked me, I have a year to commit to this, I would say 3 months for theory and then 9 months for practice. It doesn't have to be 1 year, but I would say it's difficult to be less than 6 if you're serious, if you want to be completely honest with yourself.
And I think you're optimistic. I think most people it will take even longer.
Right? Yeah, I'm just
right.
Again, for most people, like you said, might take even longer. It depends how much time you have to devote to this.
Absolutely, I agree. I want to come. So I want to go a little bit back. You made a certificate. You became a technical analyst. You learned the basics. But as you just explained, also with the smart trader system, it doesn't stop with the basics. You have to develop your own system. And I would like, first and foremost, I would like to ask you, later I want to ask you, what is your system? Please explain your system in detail. I think the viewers are very interested to understand that. But also, you became a part of the CMTA association, and you met a lot of people who, and you mentioned in the previous hour, Mr. Bollinger and Tom DeMark, and what did they give you? I mean, explain a little bit. I mean, for me, this is absolutely amazing, because I wrote the books of them, they are really heroes for me. You know them personally. What did it give it to you?
It gave me a different perspective. Well, let me begin the journey. Sometime in 2009, late 2009, the CMT Association wanted to expand from being a US-based organization to being more international. And the reason that happened is because they had they put a lot of their educational material online, so it started being accessed from all over the world. So the next logical step was then for them to group together the people that joined online from the same locale, so it can create chapters. So I was approached to create to be the founding chairman of the UK chapter. And the person that suggested, because they were looking for someone basically looking for a UK connection, and they didn't know anyone that well. But the only person that knew me that well was John Bollinger. And so he suggested, he said, go find this guy, he's our guy. And I was very honored, of course. I mean, my first meeting was with John. So subsequently, it was with a gentleman called Kentaur and Ralph Campora. So they came over. And they said, okay, do you want to run the chapter? I said, fine. So I was running it for a very long time, probably around up until from 2010 up until COVID. And we'll be beginning to reestablish it shortly. But during this period, what I got to meet a lot of established speakers, some well-known, some not very well-known, because they work in the institutional world, so they haven't published books or done anything to provide them that much, exposure. And what I found was that the depth and the breadth of knowledge that people have. I mean, given that the study of technical analysis is just a few fun, like open, high, low, close, volume, and open interest. But there are so many ways to combine it. And it was really a humbling experience to meet people that found so many new and innovative ways. And so one thing that I learned from a knowledge point of view is to get different techniques. The second thing that I learned, I kind of like knew it, but that helped me solidify that belief, was that you have to build a methodology and a time frame, of course, that is fitted for you. There is no such thing as the perfect methodology or perfect system. There is a perfect system for you. So the semi-systematic way was perfect for me, and it may be perfect for others, but it won't be perfect for everyone. It will be valuable to a large amount of people, and it's acceptable if people take my methodology and adapt it to their own needs and characters. So that was the first thing. So you can see a lot of successful people that were using different time frames and different tools. And of course, the third thing I realized was that the more successful someone was, they were less arrogant because they were more sure of themselves. They didn't have to prove anything, so they were very humble, very approachable, and if you give, they're more willing to share their work. I mean, just you shoot an email, they get the answer back. I mean, you get their point in the right direction. It was a great experience for me. I got to meet also Linda Rashke, who's also in the Market Wizards book.
It's amazing.
Yeah, actually, Linda is married to a fellow Greek called Damon Pavlatos. And now that talk about books, and Anna Maria mentioned in the previous part of the interview, which book would I recommend? Now that's a good book to recommend. I'm sure a lot of people read books on the glorified side of trading, like the Market Wizards and so on and so forth. But there is a book which actually exposes someone into the issues they had, the challenges, the mistakes they did, and that's Linda's Trading Sardines. It's very short, but very entertaining, but also very humbling, very educational. It gives you an in-depth look into how Linda works, and I was happy to have it. Actually, I'm not in my office. I would give you a copy, which Linda sent me herself. And it was probably one of the best books I've read. First of all, it's a very true insight of what goes into someone's head, even if they are at the top level, because most people may think that they have an exaggerated view of someone who's successful. But no, if you look at how it works, the reality, the day-to-day challenges, are pretty much like everyone else. And of course, it was very humbling. It was a very human touch to something that may be overly glorified.
I must say, I hope we can get Linda Raschke also once to our interview. She's really amazing. I had also the opportunity to know her. By the way, you mentioned John Bollinger. For the viewers who don't know who is John Bollinger, we have in the MetaTrader, we have an indicator based on him. So if you go here to insert indicators, and Bollinger, I think it is, now I have to be, here we have the Bollinger Bands. Yep. That's John Bollinger, what he's talking about. So really legendary people that you know.
Absolutely. It's basically two standard deviations based on statistical theory. I'm sure John can explain it much more. I'll tell you how not to use, now that we are on the issues of tools and techniques. I mean, perhaps next time I can give you the MACD, the indicator I created and I got awarded for. And but going back to the chart now here that we see here on Bollinger Bands, I'll tell you one thing that people do. They consider it as support and resistance.
True.
But actually it is not. There's no reason why prices hitting the upper band, it's just as John calls it, a tag, and it measures volatility. And volatility is one of the core, the five characteristics, the core characteristics of price.
Absolutely. So what you're saying, yes, you're right. It shows the standard deviation that it's the 95%. He uses normally the second standard deviation, and that means that 95% of the time the price should fall within those bands. And then when prices start to fluctuate stronger, then actually the Bollinger Band go farther apart. And when we are in a smaller range, they narrow down. That's what it's...
Yeah, theory says that it should be 95% if prices were normally distributed, as we say in statistics.
True.
But in practice, it's not. I mean, if you actually measure how much time is above, it's less than that.
I understand. So, yeah, so this is, this is John Bollinger, and it's actually interesting. All the people you are mentioning, John Bollinger, Tom DeMark, no, Linda Raschke, I don't think, but Tom DeMark definitely also, they developed their own indicator, and you just hinted also that you developed your own indicator. Please elaborate on that.
Well, the indicator I create, okay, now that you have a chart in front, it will be good opportunity to give you the background behind it. Okay, do you want to plot, for example, here the stochastic oscillator?
Yes. Insert, indicator, oscillator, and stochastic is here.
From the bottom, yeah, that's the one.
If you could put
period 14, say period, the K period, the K is the quick, put D as...
how much with K?
The K, leave it at 3. It's the smoothing, and the percent D, the D put at 14. You know, it's the usual default setting.
It's the usual. Wait, the usual is 533.
Yeah, you can put. George Lane had it as. Although there's a big debate with George Lane or a gentleman called Dyson did it. If you want to be putting it as 14, what's basically the average?
D is sorry. D is 14.
Yes, please.
Okay. I click OK. And maybe I give it other colors so it gets a little bit more stronger just for the screen here. Okay.
Perfect. Now, maybe you can open it up a bit and put the slow as and change it as well. No, sorry. Open the settings as well.
And the red one to make it also.
Yep. Right, okay. So can you open it? Sorry, can you open the settings again?
Yes, of course.
All right. Put the percent K as 14. Sorry.
Okay. Here 14 and here
yeah,
and here 5.
Yeah, 5, you want 3. It's this, it's fairly. All right, there you go. Now you can see it's a bit more smoother. Now I'll tell you first of all. Okay, this is the stochastic oscillator. The stochastic. Okay, let's do a bit of a intro into what the stochastic oscillator does. The stochastic oscillator basically it tells you where you are within the range of a look-back period. So if you ask the question with reference to the past, say, 14 days, as we picked in this example, my current price, is it high or low?
Okay.
So that's the question it answers. Now, one of the issues that the stochastic oscillator has is that it doesn't really measure momentum. It is considered as a momentum indicator, but actually it's not. It doesn't measure speed. It measures range. So if you say, with the past 4 days, am I high or low? And that's it, but it doesn't measure speed, velocity. And one of the issues it has, actually, before I tell you the issues, let me talk about momentum indicators in general. Now, there are literally hundreds of momentum indicators, literally. But if you want to simplify your life and try to understand where they're coming from, you'll see that they come in two broad categories. The first one is normalized and range bound, sort of like the stochastic indicator you have, and a range bound because it can go from 0 to 100, and normalized because the price you see on your chart is the same scale as it was like 10 years ago or compared to other markets. It's on a percentage basis. Basically, the number here is like 60% or 70%. It's on a percentage basis. Now, the other type of indicator you have is unbounded and unnormalized. For example, like the MACD. If you want to plot the MACD, you'll see the difference.
Yes. Okay. Insert indicators, oscillator, MACD, and
leave it as the default. 14, 12,
26.9. Wait, and maybe I make also here the colors a little bit just darker, everything, so we can see it better.
Absolutely.
Okay.
Right. So these two indicators are supposedly they're doing working on momentum, but they have distinctly different characteristics. The stochastic oscillator goes from 0 to 100, which means it has the minus that it cannot adapt with the market. So, for example, I'm not sure if I seen this in the chart. Probably, I think this was in May 2022. Before, sorry. After COVID dropped that, just go before that. Left. There you go.
Okay.
Now, after COVID, you see, now, on the rally that happened afterwards, if you scroll the cursor to the right slowly, and again, a bit more, you see the market was rallying, the indicators started rising as well, okay?
Yes.
Now, scroll it forward a bit more, no, stop it there. Now, from that point onwards, you can see, check the chart above and check the oscillator. The market continued increasing in price, but the stochastic oscillator, because it is range bound, it could not get a higher value. Because it's 0 to 100, it got pegged at this high level.
What you're saying is the market stayed in extreme territory for a prolonged period of time, right?
Yes, but the indicator did not indicate that because it could go from 0 to 100.
Yes.
Now, if you leaving the cursor where you have it, check the bottom panel, which is the MACD. The MACD continued rising. If you see, not scrolling the green line, but pointing with your cursor, you can see that it was slowly growing up. The stochastic oscillator could not do that. It got high and it stayed there.
Yes, true. Here.
Exactly. Very well, Gil. So what we're saying is these two different types of indicators. The one is the normalized and bound, and the one is unnormalized and unbound. Now, each one has its advantages and disadvantages. The disadvantage, as we mentioned for the normalized one, is that it's getting pegged at high levels.
Mm-hmm.
Can't go part. So when you have strong moves, that's it. You can only stay that high. The advantage of the unbound is that they can adapt with the markets. Exactly.
Yes.
The problem, however, with unbound indicators is that they are absolute price. They don't measure percentages. They measure ticks, pips, points. So the MACD indicator, if you look at its absolute value, so for example, where you're holding it, okay, there you go. You see, it says what's the value, 296 or 294?
Yes, 294.
All right, 294. But 294 doesn't respond to any kind of measure of momentum. It's just the price. You got the 12 moving average. You got the 26. You take the difference, so it adds up 296. But if you apply the MACD on a different product, you won't get 296. You will get a different price because it's just a function. The value of the indicator is a function of the underlying price. So that causes the problem that although you can see whether momentum is increasing or decreasing, but the value it has is useless. You can't compare it over time. And you can't compare it across securities because now we're seeing what's the chart of the S&P 500, right?
Yes, that's the S&P 500.
Perfect. Now, if you try the MACD on something that is very, very low priced, like a currency, the MACD will not be 265, will be 0.001.
Yeah, because it's pips.
Exactly. So you've got the differences in the MACD do not relate to different levels of momentum. It's just a function of the underlying price.
I understand.
So at that time, around 2015, having noticed the limitations of these two broad categories of indicators, I wanted to create a new type of indicator which would combine the benefits of the stochastic oscillator, which is a normalized reading,
Mm-hmm.
and the benefits of an unbound indicator, which is freedom to move.
I understand.
So what I did is I took an unbound indicator, the MACD, and normalized it. So I had, in theory, the best of two worlds. And I published this work that I did in 2015 in 2022. And it was, innovative, groundbreaking, however you want to call it. But it got awarded by the CMTA Association. They have an award, it's called the Charles Dow Award. The Charles Dow Award basically is an award for innovative research.
Okay.
I think if memory serves, about 25 or 26 people have won it in the world. And in 2022, it won first prize for my work on the MACD. It was a 40-page research. I mean, people Google it, they will find it. And also, I sent a paper to the National Association of Active Investment Managers. They have an equivalent competition. It's called the Founders Award. When again, they provide awards for advances in active investment management. And they also found it very useful and awarded it. I think it creates a breakthrough between these two categories of range-bound and unbound. It creates, and it will be freely available. If you want, I can provide you with a code, and you can freely distribute it to your users. I don't get anything by it. I mean, the code is already out there. It's public. I mean, it's public property, but it's public knowledge.
Okay. Now, so you. By the way, did you study mathematics, or how did you come up, or was this just a determination, and you learned everything?
Well, that's a good question. Well, the way I figured it out is by trying to reverse engineer what was wrong.
Okay.
All right. So we talked about, trying to normalize the two types of indicators. To be completely honest, there was an attempt to normalize the MACD,
mm-hmm.
but it doesn't work. And I'll tell you what the normalization is. So the formula for the MACD is moving average 12 minus the 26. Okay.
Yes.
So what they did is 12 minus 26 divided by the price. So they put it in percentage.
Okay.
So you don't have 256, whatever is the value of the MACD, 256 as a function of the price of the underlying asset. So it's 256 divided by the value. What's the value of the S&P 500 now? Divided by the S&P 500. And if you multiply it by 100, you get it in percentage. So basically, it's a percentage MACD. I did not discover this, but it was already available. Now, the thing is, if you look carefully into this, because of a factor that I will mention later, this percentage normalization is not successful across markets. It works across the same asset class.
Okay.
But if you compare the MACD percentage, PPO as it's called, for example, the S&P 500, in the paper I compared S&P 500, natural gas and bonds. So if you compare it, you will find it has different fluctuations.
Okay.
So that's where my question came, and I said, why is it? Because if you're comparing theoretically oranges with oranges, it's percentage with percentage.
Yes.
But sometimes they oscillate more than the other. And then I looked under the hood and I found that it was due to volatility. Because natural gas and or even something like cryptocurrencies has a lot of volatility.
Yeah.
But a market like bonds has very little volatility. I mean, less.
Yeah, absolutely. I mean, bonds, they go up 0.1% per day, 0.1% down. But cryptocurrency can go 5% up or down in a single day. Stocks even like more, right?
5% is it's a Thursday. So when I looked at it, I said, you got percentage on bonds, you got percentage on crypto or natural gas, but it doesn't compare. But I said, the difference is volatility. That was the breakthrough. To cut a long story short, so instead of dividing by price, I divided by volatility in specific average true range. And having that normalized indicator, then I started creating techniques. I found ranges when it creates overbought and oversold levels, creates fast and momentum. So I created the 7 range rules, as I call it. I took the name actually from someone called Andrew Carroll, a friend of mine passed away. So I created the range rules. In this paper, it is outlined. And then I created this indicator. I even have it before. Like I mentioned, there's no pitch. People can have it for free. And having these 7 ranges, the range rules, I can identify what the market is, whether it's overbought or oversold, but truly overbought, not like you have here with the stochastic oscillator when it gets it's high. And so risk level 1 to the upside, these range rules come as an acronym of 7R. So risk to the upside, risk to the downside. So when you're coming off of a risk, oversold, it's rebounding. If it continues, then it goes rallying. Risk again to the upside, then it is retracing, then it is reversing, and then risk to the downside. So that's 6. So it's the 7th if it's ranging. Mm-hmm. So if you apply a time filter, for example, if the indicator does not go very wildly up and down, but stays within a range, it means that there's not much motion. And that's one of the problems that trend following indicators have.
Exactly.
Is that if you cannot filter them, but with the MACD, you can actually filter it. So to cut a long story short, if I say the MACD stays within a range for a few days, then the market is ranging. So using these 7 core ranges, combining with other tools, you can create a lot of patterns, very systematic.
I see we have to do another session together. But here, now, so you created actually the first indicator probably that is working also in a ranging market and also in trending markets, which is a major challenge always to define when I'm ranging and when I'm trending.
Exactly. It can do it in a very simple and mechanical way when it's trending or when it's ranging.
That's amazing. So, but you mentioned also in the previous sessions and also here that you do fundamentals and you do technical. So you use this indicator that you created by your own in probably the lowest time frame, as I assume, because in the bigger time frame you use fundamentals, right? So you use the indicator for the momentum, for the signal to enter.
Yes, that said, Gil, you can use it on the monthly chart as well. There's nothing wrong with it, and sometimes I use that as well to get a gauge of because I want to be doing multiple time frames, not just of the factors but also the momentum. So, for example, for some patterns, I may have I want the MACD, the MACDV actually, to be doing something on the weekly chart. So I do to be completely honest with you, as a setup for a technical reason. It's just that the bulk of my work, all the other time frames, the monthly and the weekly, is primarily fundamental. But on the weekly, I do use technicals as well.
Okay.
So, or another pattern that you can use. I'm just giving you the secrets. I mean, you might say, okay, on the weekly chart, I want to be having the histogram, because that has also been normalized to be in an uptrend, and then look on the daily to look at the MACD as well. So the MACD histogram to have is at a setup on the weekly, and the MACD itself, not the histogram, on the daily.
Amazing. So you look, when I understand you right, you look at the fundamental picture. You get a general view of the direction based on fundamental analysis and the COT report and seasonals. You get a bias. That's what I understand, right?
Absolutely. Let me, I don't know if it would be possible. I have a PowerPoint presentation, just one slide. It doesn't, unfortunately,
it will not be possible. But what we can do is, so maybe
have any charts on it though.
Maybe tell me a chart that you want to show, and then let's start from the big picture and try to scroll down from the big picture to detail.
So I've got, I'm not sure if it's possible to share it. Yeah. In any case, I've got a chart here of the whole process, how it works.
So we will do another session probably on this, right?
No problem.
But let's say, give me a chart, or let's also maybe ask the viewers if they want to see a certain chart and that you are analyzing it for them a little bit.
Yeah, okay. Obviously, it will be just for technical reasons. It won't be for, the fundamentals and the whole thing. But yeah, gladly.
Yeah. No, I would actually also like the fundamentals, like just your general view. Let's say, I mean, everybody's always interested in gold. I don't know if gold is your core market. You want to start? You want to see gold?
Yeah, sure.
Okay.
I have a chart to gold, please.
So we go here into, and I start in the monthly chart.
Yes. Well, for the monthly chart, what I would do here, well, on the monthly chart, I'm more interested in trend than anything else, and of course, on the monthly chart, I usually put statistics, economic statistics that underlying it. On the monthly chart, I usually have it on a close only basis. I'm not interested in the highs and the lows. So what I do is I will overlay at the bottom panel various economic statistics that you can use with the market that you're studying. Following that, I will go to the weekly chart. Do you have any commitment of traders report on your MT4 now? Because you actually use it.
I have maybe, I mean, I just have the old report open here.
A legacy, yeah.
That's the legacy report. Do you use the new or the old one?
The legacy, but I'm also using the one, but I've started continuing with the legacy, the old one.
It's easier.
Yes, it is.
It's easier. It gives clearer signals.
Yes, it does. It does. Well, actually, you can. Yeah. So when I going into the weekly, I think I saw one of your spreadsheets also had some kind of a chart with the commercials and the large specs. Do you have a chart of it, even if it's in Excel?
A chart for the COT report?
Yes, please.
For gold?
Yeah.
I can show here. This is my data. Gold we have here.
Right. Yeah. Okay. So
here down we see the price on the weekly chart. It's in a line chart, and here we see the institutionals.
All right. Okay.
So we have here the non-commercials, the blue line,
absolutely.
And the purple line are the commercials.
Exactly. So this is what. So the way I look at this is two. The first one is patterns of the commercials and the speculators.
Mm-hmm.
Or I apply various indicators on the data. I think the best use is use them in combination.
Okay.
So through that, my work says that I'm bullish on gold.
Okay.
As an outlook. on the shorter time frame, there are indications that a market may actually need to cool off a bit.
Because of the thing that we saw.
We had the peak. Well, basically, I don't think. Well, if we switch from fundamentals to technicals, the technicals can be trends, momentum, volatility, pattern recognition, swing highs and swing lows, and market structure, and then relative strength. So these are the core 5 aspects of price. So I don't have any overbought or oversold indications coming from momentum, like MACD or the MACD histogram, but I have from volatility.
Okay.
So it needs to work off that higher volatility, and then because as Bollinger says, high volatility, low volatility is where trends are born. High volatility is where they go to die.
So you think, so we have here too high volatility, and you think this uptrend is gonna die or slow down?
In the short term, I think the market will cool off.
Okay.
So in order to bring my view into action, like I mentioned, the 4 steps: setup, signal, stop, and size. What we're talking about, and of course I will use my own tools, I won't be just eyeballing the chart like indicators and everything. The setup. Now, once I have, say, for example, look at the setup, and I'm, say, bullish or bearish on something, the signal generation, I have a system who will tell me enter now, enter there. But I will not use it on its own, just because it gave a signal. It has to be put in context of the setup.
Okay.
And from a signal point of view, if it goes below, I think it's, if memory serves, Tuesday's lows, you might have a short-term sell.
Okay, so if I go into the daily chart, we are in Thursday, so Tuesday low, if we go here below this level, it's a sell.
A short-term sell.
Yes.
Now, this is
the big picture, you say, it didn't change, right?
Yes. So this is where it becomes discretionary or judgmental, because your fundamentals may say one thing, but if you get on the short term something which is counter to that, you may say, okay, I don't want to be taking the risk going counter the trend. So it may be a matter of personal choice to be short or flat.
I understand.
So that's where it becomes a personal issue. Some may be more, because if you see now you're massively against the trend. The long-term trend is up, the short-term trend is up, the intermediate trend is up. So you have to be really, really careful going against the trend. I don't want to be. Usually, as far as I'm concerned, I try to avoid going against the trend. I've been burned so many times. I've learned my lesson.
But you know, what I find fascinating, and this is what I see always with experts, and I see this again also with you, and this is so special, and I want to share it because I think it's for the viewers also. You have studied the markets really deeply. You developed your own indicator. You make back testing and everything. And in the end, you still also part discretionary. And I think I see this, by the way, with all successful traders. And I think there is a truth in it. Trading is not only, even if we master it, even if we study it, even if we want to try to quantify it, there is also a part of it that is art. Maybe experience, or I don't know how to call it.
Completely, Gil, I completely agree with you, completely. And I think the main point is, yes, I mean, we understand the need for clarity, for discipline, for structure, but unfortunately for us, markets change. Mm-hmm. So we have to combine the need for clarity and discipline with adaptability. I wish it was as simple as getting a mathematic formula and it would work forever. It doesn't. On a first principles basis, like saying momentum in general as a principle, it works. But which tool you use, the settings, these evolve around market cycles and so on and so forth. So that's why you have to keep a discretionary part to it.
I mean, this is so fascinating. This is for me very, very fascinating because I struggled in 2016. I had a trading strategy that worked very, very well. And from 2012, I made amazing a lot of money. And then 2013, I made good money. 2014, I made a little bit money. 2015, made very little money. And 2016, it stopped to work, my trading strategy. And it was for me a huge struggle between the things that I learned to have to be disciplined and just to continue, and it's just a statistical game, and recognizing that markets are changing. And this struggle really kicked me out of my comfort zone. And I think I could talk to you just about this thing that you're saying, that markets are changing. I could talk to you an hour about it, because I think this is absolutely amazing what you're saying here. But we are already at the end of our second session. It's unbelievable. Alex, I so much want to thank you for giving your knowledge here. It is an absolute honor to have you here.
Thank you so much. I really enjoyed that conversation together. It was. I mean, literally, the 2 hours passed by, and I think if you asked me how much time I think spent time talking with you, I would say probably half an hour.
It's for me the same, absolutely the same. And so BMG is asking which kind of indicator would you recommend. So obviously BMG is recommending MACDV. That's
let me actually rephrase the question. I think that you need for the job you want. I don't think there is one perfect tool to do the whole job. So if you want trend, you need another one. If you want momentum, so it's best thing to create a taxonomy of. So MACD is for momentum. If you want to use it for trend, I would say something else. So if it's perfect, so if for pattern recognition, I would use something else. There's no perfect indicator that goes for everything. Of course, if you ask me, you're in a desert island and you have to use one indicator, in that case, I would probably use any indicator because I wouldn't care. So, yeah, just make sure you don't. I don't want to be. MACD is truly an innovation, but I want to be mispresenting as like the be and all of everything. It has its time and place. It's good for that, but for other things, you may need other tools.
Thank you so much, Alex. It was an absolute pleasure. I hope to see you soon again.
Absolutely. My best everyone at XM, you did a wonderful job. Thank you so much for organizing this, everyone. It was a wonderful effort. Congratulations for that, for bringing education to the people, because I think they really need it. And that's it's a big difference what you're doing, because information is not knowledge, and you're trying to bring knowledge, not just information.
Absolutely. Thank you so much.
Thank you. Have a nice day.
You too. Bye-bye.